Good morning, everyone, and welcome to our What is the Business Worth? Getting the Highest Return on Your Investment webinar. My name is Teresa, and I will be your tech support and organizer for the webinar. Our presenters today are Pauline Davis, the Assistant Director at the Florida SBDC at UCF, and Jose Molfino, Area Manager with the FSBDC at UCF in Lake County. I'm going to let them introduce themselves, and then we will move on to more introduction.
Good morning, everyone. This is Pauline Davis, Assistant Director at the SBDC at the University of Central Florida campus. We're right there in the Fashion Square Mall. A little bit about me and my background. I have been at the SBDC for quite a number of years. My specialty is the accounting side of things, but I also do business planning, accounting, a little bit of marketing. It just depends on what the business owner may need. So just bear in mind, we're here to help you. I like the numbers, and hopefully we'll be able to look at some of your businesses and see what you can do or how we can help you make it a little bit better.
And I am Jose Molfino. I'm currently the area manager for Lake County, and I have been with the SBDC for around 5 years. The first 3 years I joined the organization as a volunteer advisor in a program called the ABC, which basically put a board of advisors for established companies in Central Florida. It's a great program that the SBDC has. And then I joined the organization as a business consultant once COVID hit, and the SBDC needed to put additional resources in order to help the business community. My background is in finance, business strategy, and operations. I have been lucky to have a kind of an international career, working in 5 different countries, from a small to big organization. And I am glad that I can be a resource for your business today.
Thank you so much, Pauline and Jose. Let's get it started. So a little bit about the Florida SBDC. We were established in 1976 by the U.S. Small Business Administration to provide technical assistance to small businesses. The Florida Network is a part of a nationwide network of Florida Small Business Development Centers with nearly 1,000 local centers across the U.S., the 50 United States and U.S. territories. We are funded in part by the U.S. SBA and the state of Florida. We are state designated as Florida's principal provider of business assistance, and we are nationally accredited. That being said, if you are joining us and you're not from our Central Florida or Eastern Central Florida area, this is just to let you know that there is likely a service center close to you. While we are very interconnected with the other centers in Florida, we will also try and help you find one closer if you do end up trying to meet with one of our consultants. This is our Eastern Florida area that UCF does cover. We are also connected to our local state colleges in this area, but this is our 8-county region that we cover. That also being, want to also repeat here that we are very interconnected with the rest of Florida. So if you aren't in one of these 8 counties, go ahead and register for consulting, and we will get you to the place that's closest to you. Our services provide no-cost expert confidential one-on-one consulting, no-cost market research. With the amount of state colleges and universities we are connected to, we do have a lot of availability for research. We also have special programs for second stage businesses This includes, as both Pauline and Jose have mentioned, the ABC program, which is our advisory board council. There are certain things that you have to have in your business, sales, employees, and years in business in order to qualify for some of our special programs. All of that is available on our website, sbdcorlando.com. And each of our areas does have their own set of special programs that they offer for second stage businesses. So we're not just a startup resource. We assist businesses from the beginning to the end. We also offer business trainings like this as seminars in person or webinars online. And before we get started and have Jose begin his presentation, the handouts that Pauline and Jose will be discussing, including this presentation itself, are available in your handouts tab on the GoToWebinar platform. If you have any questions, please use the questions chat box feature. We do not have the raise the hand feature, and we do not have the ability to answer questions from verbal. So we ask that you please ask your questions in the question chat box. Please ask them as we go through the webinar. While we will be waiting to the end in order to answer the questions, having that ability to ask them as we go, or for you to ask them as we go, tends to allow people to not forget by the end of the presentation what their question was from the beginning. There will be an evaluation from this webinar because we are publicly funded. We do have to have evaluations and return those evaluations to our funders and let them know how we are doing. And we would appreciate you taking time to complete this evaluation, which you will be receiving by email in about an hour after the end of this webinar. So without further ado, I'm just going to hand it over to Jose, and I hope you all enjoy the presentation.
Thank you, Teresa. All right, this presentation has mainly two parts. I will go on the first part, reviewing some of the concept of the business valuation and the importance of them. And a second part where Pauline will show you a sample report that we can generate for your business at no cost for you. We are part of a database that once you send us your financial statement, we can run a software and provide you with some valuation numbers. So Pauline will go through that report to show you how powerful that is, and also how that report can help you with some of the key metrics that can help your business increase their value. All right, so part of the statistics that we have is that 98% of business owners actually do not know what is the value of their business. So we are hoping that with this webinar, you are going to be part, if you are not already, part of the 2% of small business owners who will know or already know the value of their businesses. The business valuation is really not an exact science. The idea with this exercise is actually to have a range of values. There won't be just one particular value. I mean, this is the value of your particular business. We will provide a range with this report, and that range is coming from different valuation methodologies. So it's important to know each of the valuation methodologies so you understand what value is coming from each of those activities. At the end, what we want is really determine what is the price that a particular business will be able to be sold, or any participant in or investor are willing to pay for a particular business. Some perceptions of businesses. This could be an actual business operation, which is very intensive in manual work. There is probably not much automation, or not overall business strategy and a roadmap for the future. May not have probably some budgeting exercise built upon, or a strong people strategy as well. They might lack some automation as well. This is a perception of most of the business owner, which is a highly automated and futuristic operation. So it's always good to understand what is the perception and what is the reality, and this is the aiming that we as an SBDC are trying to convey to all our clients, as a mix of automation and standardization of your business process with a strong business strategy and a good people strategy where your employees can succeed as long as with you in the company. Part of that is having and a strong understanding on what is the value of your business right now, and where do you want to take that value in the future. Why is important having evaluation? Not only as the first line mentioned for buying or selling a business. Yeah, that's mostly what people require, or clients require, when they reach out to us. They are in the process of probably wanting to exit the business, or they are interested in selling in the future. So, or they are approached by a private equity organization that are interested in buying the business. So that's one part where we normally see businesses that require business value, but it's not the only one. Financing is a strong one, but we always suggest that owners know what is the value of their business, because they can see how much additional debt they can take without going to financial distress, right? Appropriate level of debt over equity is important, and not to exceed a range. So understanding what is the capacity of the business to increase or decrease debt, the valuation is an important tool. Business planning, if you want to take the value of your business to a different level. Remember that valuation is a picture at one particular moment. So if you generate the report of your company right now, that picture will show you that particular value at this point of time, and then you might have some strategy to take that value up in the next few years. So business planning is also, valuation become an important tool of that particular business strategy and long-range planning. Exit strategy, as I mentioned, if you are in a near term looking for an exit strategy, or a long term, 2, 3, 5 years from now, the business valuation is a good tool to provide value for your business. And of course, some particular activities like divorce, gifts, or any type of tax implication. So we normally use 3 main approaches of valuation for any particular business. The cost approach, which is basically using the balance sheet of the business, or as other mention, is what is the replacement cost of starting a business from scratch. So what are the capital that is needed, and what is the asset that is needed to launch a business on that particular industry. The market approach is basically a comparison of previous transactions where you determine the value of the business based on historic transaction of similar companies in the same industry. And the discounted cash flow is more a look at the future, especially important when there is a growth factor involved in the operation. So we will go in a little bit more detail on that. As I mentioned, the cost asset approach will basically get the information from the balance sheet. That is why it's important to have that information in order to produce the report. So the software will analyze and we will analyze as well how the asset has been growing in the last few years, especially some of those components that we will see in the next slides. Also the debt implication and how important for that particular business could be any type of intangible assets. Sometimes those are removed, so that valuation may have some hidden value that this particular approach might not be providing. So some advantages is that it's easy to calculate based on the balance sheet numbers. Sometimes it gives you a clue that the valuation might be too low because some of the asset has been highly depreciated. So many times it's possible to do a revaluation of assets based on the market value. Some disadvantages, as I mentioned, some goodwill or brand value of the business might not be part of the valuation, and that could be an important component of the value of the business. The next one is the market approach. Market approach is basically to analyze what other business transaction has been done in the past. And normally this valuation uses a multiplier, either sales or EBITDA. So if in the previous transaction in that particular industry, business has been sold for, let's say, 3 to 5 times sales or 5 to 6 or 7 times EBITDA, then that multiplier is more or less applied to your business and arrive to a valuation based on that comparison of past transactions. Some advantages is there are many data available. Most of the time there are other transactions in a particular industry that can be extrapolated for your business. The appraisal might not be accurate because sometimes it changes over time. When the economy is good and everything is growing and credit is available, those valuations tend to go higher than when there is a recession or more difficult economic conditions. The cash flow approach is one of my favorite approach because it takes a look at the future of the business. This is important when the business is growing because it includes some assumptions for the future of the operation. So you can include actual growth factors in terms of revenue, or if you are doing an additional investment in terms of capital or expenses, resources, people, etc., you can put those assumptions into the next 5 to 10 years and bring that value to a net present value and see what is that particular valuation. Of course, as all the valuation has their bias, you are using past performance because you are starting from a base of current activity, and that not necessarily will pan out in the future. So as I said, this is not exact science, but having all these 3 approaches will give a very good range of the value of the business. As I mentioned, we use a combination of those 3 approaches and additional data in order to understand what is other components of the business. If they have any particular operation that is different from other competitors, or any patents, or brand recognition and things like that that can increase the value of the 3 approaches. We ask you to provide income statements of the last 3 years, basically to see the progress and especially when we are doing the valuation of discounted cash flow, you can see if there is growth that has been going on in the past, and this growth will be sustainable in the future. Like for example, here, this company has gone for $500,000 in sales in year one, almost to $1 million in year three. So there is a big growth component here, and it might continue in the future, it might not, but understanding the drivers of this business is important to get a more accurate valuation. For example, the gross profit has gone from 29.4% to 29.1%. So it's a little bit of compression on the gross margin profit of this business. But the operating expenses has gone up from 127 to 162, from 26.5% to 18%, which is good. I mean, the sales has grown at a larger speed than the total expenses. This is a good formula, revenue growing at a faster rate than expenses. That is why the operating expenses is decreasing in terms of participation over sales. So overall, the net operating income has gone from $14,000 to $100,000. So in terms of valuation, using a methodology of future cash flow, if the company continue to grow, that's normally a methodology that we will bring the highest value of this particular business. The balance sheet, again, we also require, having at least 3 years. It's important to know what is the cash component of the business. Part of the valuation will take out this cash or just leave, a small amount of cash that is the minimum needed to run the business. This business also has improved their cash situation from $6,000 to $45,000. Also, current assets has gone up from $38,000 to $115,000. Fixed asset has remained the same, and total asset has gone from 188 to 244. But there is a non-compete covenant there. So that's part of the evaluation, is try to understand how important is this asset, especially if you are calculating the replacement cost. Is it needed or is not needed? So that additional information is always important. In terms of debt, the company has decreasing current liability as well as debt, total debt, from 125,000 to 19. So if you need evaluation to understand additional investment that will be funded with a third party, meaning a loan, for example, that valuation will be important because you know how much additional debt this operation can take, maintaining a healthy business. Equity has gone up from 63 to 224. So if using the replacement value in year 3, the valuation has going to be higher than if you take the valuation at year 1, because it has more cash, more assets, and less debt. And I will leave you with Pauline that will explain how the report work, and it will go into the detail on all the activities that this report has. Pauline, with you?
Yes. So throughout the years and working with small businesses, most small businesses or most business owners view their business as their babies. So they have been working on this business, pampering the business, but they don't have a realistic view of the value. So you can think of your business value as your house. You have lived in this house, you have painted, replaced, you have done all of these things. And so now you're thinking that your house has a certain amount of value. What these programs have and can help you with is to be realistic as to what the value of your business is and what are some of the things you can do to improve those values. Now, I'm going to show you the report after I go through the next few slides. But basically, what is nice about this Biz Equity report is that it gives you 4 values. And the values vary depending on what you're trying to do. Now, don't get intimidated that I'm not an accountant, so I don't understand a lot of these numbers, because it doesn't take a lot for you to get the valuation, and you are not going to be the one actually calculating the numbers. So the program is going to do a lot of the calculation, and then we're going to help you in terms of the interpretation. Okay, so basically, when we put your numbers through this Biz Equity program, we'll get basically 4 values. Now, the equity value is usually or sometimes the highest value, because it's going to take into account the cash that the business has, the receivables, you know, all the assets minus all the liabilities. So if you have a cash rich business and a high receivable business, then of course you're going to get a higher value. But realistically, when people sell their business, they're not going to sell the business with the cash and the receivables. They're going to say, hey, I'm going to take my cash out and I'm going to collect as much money as I can out of this business before I turn it over to the actual owner. Where the equity value is probably most important is maybe you're bringing in a partner. Maybe you're at the stage where you say, you know, give me this amount of money and I'm going to just walk away from the business and give you everything. The asset value does not include the cash and the receivables. If you look in the presentation, and I don't want to, you know, read line by line, it's more, you know, your fair market value is going to include inventory, furniture, fixtures, and a lot of the customer base goodwill. The enterprise value is a little similar to the asset value, but it will also look at the debt and the equity in the business. Most businesses will either sell at the asset or the enterprise value, depending on what the arrangements are. The liquid value is probably the lowest of them all. And that's pretty much when you say, okay, I'm closing the door, you know, whatever I can get, I get. If I can sell off the chairs, the desk, the equipment, that's what I'm going to get, okay? Unfortunately, a lot of business owners, because of lack of planning, when they do decide to exit the business, they're going to get the liquidity value. So for the last couple of years, we have been helping a few business owners sell their business. And this is what I will tell you. As a business owner, you never want to sell, you know, say, okay, I want to sell my business this year, and you're going to sell it. You want to know where you stand, what is the value now, and then what you can do to improve on it. And that's where we find most of them have gotten the most return on their investment, is more of a planned approach. But that's not to say, you know, if circumstances change and you need to see what's going on. Now, not all business owners that know the value of their business is doing it for selling. You know, you might want to say, okay, I'm passing it on to, you know, my children. So this is what it's worth. I want to grow the business. What will it take for me to get to that point? Okay. So what is nice about, as I said, this report is it's going to give you that 4 values. And we see most of the business come between the asset and the enterprise value when it comes to selling their business. Did you give me control, Jose? Okay. So in terms of how are you doing, as we said, it's not necessarily totally to sell. But when you also look at your business, you want to look at the industry and you want to get to have an understanding is, how is my business rated in the industry that I'm at? Am I above the industry average? Am I below the industry average? If I'm below the industry average, what do I need to do? The last couple of years with the pandemic, what we're seeing now is sometimes the way business used to be run, it's not going to be run that way. We're seeing prices going up. We're seeing different things happening. And if business owners cannot react accordingly and quickly enough, they're going to be really at a disadvantage and could possibly put themselves out of business. As we work with the business owners, we're finding that, nobody wants to raise their price on their customers because of the fear that, they're going to lose those customers. But when you explain to them that, hey, this is what the industry is doing, this is what's going on, you have to make these changes or you will not have a business. So when we look at those income statements that Jose showed earlier for that particular company, we find certain things like their return on equity is above average. Their interest coverage ratio is above average, meaning that they can afford to borrow more money. The income to revenue, how much income they're having in comparison to the revenue that they get, the sales, it's 8% above the industry average. So you want to be above the industry average. You don't want to be below. So inventory turnover, they're saying it's below average. And this is kind of the industry turnover ratio is not something that you should really ignore, because, when you're holding on to inventory in your business, that's tying up your cash. So you want to kind of figure out what's the best amount of inventory I need to have, how much inventory should be turning over every year. Your debt to equity, it's still it's lower because, are they increasingly borrowing money? And then the fixed asset turnover, not that bad, but it's still below the average. So these are some of the things that you want to take a look at in your business and to make sure cash to debt ratio, that's below the industry. That could be a little bit dangerous, because if you don't have the proper amount of cash, are you going to be able to pay your bills? So the report is going to take a look at quite a few things for you, tell you where you're at, where you need to make the adjustments to increase the value of your business. Sometimes when we go over these numbers with clients, they're terrified because you run your business by instinct. So to actually see numbers that's telling you, are you doing good or bad? You want to know it, but it's also a terrifying experience. So as I said, we can do a business valuation for you. We can give you those numbers, tell you what you're valued, and also help you to take the business to the next level. It's not that complicated, and we can help you with that. So this is an example of the report. It's very, very professional, and you can use it to, give it to your partner, take it to the bank. It's really a very informative and professional report, and it's no cost. So I'm just going to go through the report briefly with you so that you can have an idea of what's going on. So you have your table of contents. And as indicated in the beginning, it gives you your different values, your asset value, the equity, enterprise, liquidation value. It gives you an indication on your key performance indicators. So if it's green, you're above average, blue meeting industry average, and purple, you're below average. So as we said before, we're doing the calculations for you and helping you with the interpretation. So don't be too intimidated as to say, how do I do this? What do I have to do? Actually, all your job is to provide us with the last 3 years income statement and balance sheet, or your last 3 years business tax returns. That's it. We will use the right numbers and give you this end product. Okay. So remember, it gives you the description of what an asset value is, equity value, enterprise value, and what it means for your business. So you have all the explanations here. We talked about the different approach to coming up with the valuation. Once again, it gives you the equity. Remember, we saw that in this slide previously, and the explanation of exactly what does that mean. Okay. And then it gives you the 3 values: the asset, the enterprise, and the liquidation value. This is all will be in the report. Now, realistically, when to do the valuation, this is what we need. And we're taking it out of your financial, so you don't have to do anything. The revenue, the income, owner's compensation, interest, cash, accounts payable, receivable, inventory. That's all we're asking you for. And we're going to, as I said before, get that information from the financial statements that you provide as well, or, you know, your income tax return. I'll go to the next slide, because what it will do is to put those 3 years that we put together side by side. So business owners always find it very interesting when they put information side by side. So as indicated before, you see the sales are growing from 2018 to 2019. You see the pre-tax income is growing. These are really ideal situations for a better evaluation, okay? So most people are saying, well, what is the number that gives me the biggest trigger in terms of valuation? I probably would tell you that it's the income. And, you know, you're always hearing people talk about multipliers, where they'll say, okay, oh, your business value is 5 times your revenue or 6 times your net income. A lot of those are a lot of misunderstanding. So we're going to take a lot of that misunderstanding. This software is owned by a company that have bought and sold businesses for over 20 years. So they have a lot of historical information that they can use to internally calculate the multipliers, okay? So this business doesn't have any interest expense. Usually the non-cash expenses would really be if you have assets that you're depreciating. One-time expenses we saw back in with the pandemic, you know, you see one-time expenses, one-time revenues, where some clients get PPP loans and, you know, different grants. So these are things that are not going to be reoccurring. Maybe one-time expenses, you know, you had a flood in your business, so you had to spend $20,000 to do some quick remodeling, but it's not something that is going to be recurring. Then, you know, it looks at your balance sheet. The assets are improving nicely. The accounts receivables are improving nicely. So, you know, as we're looking at it, we'll point out certain things to you, such as this company, their sales are increasing, but their receivables are also increasing. lots of time business owner will concentrate on sales, increase in revenue, but not necessarily concentrate on collecting their money. In this instance, this business does not carry inventory, so that's not really, necessary. It does have some fixed assets. Sometimes I don't put intangible assets. This is kind of a management decision, depending on what those assets are. And realistically, if you sell the business, will it carry through? Okay. We also try to look at the debt. The company is paying off some of their debt, so that's good. They do have some long-term debt, but once again, they're putting themselves in a really good position. And this is why it's good when you're thinking of maybe an exit strategy at some point. If you do it, a couple of years before you're actually ready to go out and actually exit the business, then you can put some of these things in place. It almost looks like this company has been deliberately planning reducing their liabilities. Okay. And then remember, we talked about the key performance indicators. I'll move down a little bit in the report. If things does not apply to you, of course, you won't see anything. So in this stage, this is a nice graph because, some people are very visual. So it's showing you the blue indicates revenue, nice trajectory in terms of revenue. The black here is looking at your debt. So as we saw before, debt is decreasing nicely. Pre-tax income is increasing. It's not increasing on the same trajectory as the revenue. So now, of course, we're going to look at that and say, okay, what's going on? If your income your revenue is increasing, why is not your tax income increasing? Realistically, it takes money to make money. So sometimes you'll have a growth phase where the revenue increases, but not necessarily the bottom line. And of course, receivables is increasing slightly, not that much in comparison to revenue, which is a really good indicator. Okay. Return on equity. So, in the previous years, didn't have much. 2019, it was really below the industry standards, but on 2020, it's back up and it's looking a lot better. And of course, this will give you a complete description of what the return on equity mean and how it was calculated. So as we said before, the purple, you're underperforming, green, you're outperforming. Okay. The receivables conversion over time, to me, it looks good. You're collecting your money. Okay, so you're outperforming the industry, even though, as I said, the receivable did increase, but it's not substantial when you compare it to the amount of revenue. They did not have any inventory, so that's not an issue. Fixed assets, it's increasing a little bit. So, but your fixed asset is supposed to be the thing that's generating your income. So if your assets are increasing and your revenue is not increasing, that's not a good thing. So, but in this case, it says you have the assets is turning over to generate you sufficient net income. The debt to equity ratio, I guess in this thing is showing that although I think your debt was decreasing, but it's not substantially not. I would say at a glance, this is not something to really worry about, but as you're trying to grow your business, you have to really pay attention to everything. Interest coverage ratio didn't show any interest. The cash to debt, remember when we start out, we didn't have much cash in the business, but the last year the cash increased significantly. So in the earlier years, I could probably say they might have been having a cash flow problem. That's not to say in the 2020 they weren't, because these reports are calculated at a specific time. So usually at December 31st, whatever that date is. So if December 31st, it looks good, that don't mean in the middle of January, you won't be having challenges. So you just have to be able to interpret it, the data. Income to revenue, they're saying the net income looks fine compared to the revenue. So except for that first year. So you not only want to increase your revenue, you want to make sure that your net income is increasing as well, because if it's not increasing, you have just given yourself more work. Cash flow compared to revenue, that looks, they're saying for the amount of revenue you're having over time, you should have more cash flow. That is something to look into, to say, sometimes businesses will take the money out of the balance sheet and put it someplace else. So a business might be looking fine in terms of profitability, but the cash flow is low. So once again, the question I will ask clients is, okay, so this says it's below the average. Do you have another business bank account someplace else? Receivables to income over time. Once again, we say you're collecting your receivables. Okay. And although this report is giving you numbers and key performance indicators, remember, this is probably for a nationwide, but that you can always do better. So, don't say, well, that's what the industry says. So, always look and see where you can improve your business. Your fixed assets to income over time, it says you're outperforming the industry. So that's good. Except 2018 is gone. So, but you can see the improvement. Debt to income, once again, they're in that last year, seemed like there was a lot of debt paid off. Okay. And that's about it. One of the things that the report will tell you is the larger your revenue, the more of a multiplier you're getting. So a company with with lots of revenue sometimes can get a little bit more value than a smaller company that might be on page look a little bit more profitable. So if anything I can tell you in terms of this is, this is an indication of what your business could look like. Now the SBDC can help you to figure out, okay, what we're going to do, what is the next step you want to do for your business, and help you to get there. So hopefully you'll be able to have us do some of this business valuation and improve the overall value of your business. And you'll have this report that you can really take a look at, have your accountant look at it, or who your advisory boards are, and kind of also give you some opinions. So that's my part of the presentation. So I will turn it back over to Jose.
Great, thank you, Pauline. I think this is a good time to take some questions. Teresa, if you have some of them so we can go over them.
Okay, we do have 2 questions right now, and you guys, this will be the time if you guys want to start typing in your questions while we review these 2. we will get to them as soon as possible. Question number 1, a lot of small businesses are heavily reliant on the owners. Can you talk about transition and how to avoid the business failing when owners leave too quickly or without proper transition?
Well, that's an excellent question, because the owner many times, especially at the beginning stage of the business, is the driver of the result of that particular business. So, having a business strategy where, the people component is part of that transition, where the owner can disengage from the daily operation and bring professional operators into the business that can continue to keep the business running or take the business to the next level in terms of growing additional resources and so forth. So that definitely should be part of the strategy, especially if the owner is thinking on exit strategy, is discuss what is the people strategy in the future, and how can hiring people who can still manage the business at the same level that the owner has been doing it before. It's part of that exit strategy. Pauline, I don't know if you want to add something.
Also, yes, in the business valuation software, one of the questions they do ask is, what will happen if the owner leaves? Or will it affect revenue? So definitely, if this business is solely driven by an owner, that's that can be a problem. It's going to negatively affect the value of the business.
Thank you so much for your answers. If you have any follow-up questions, please type them in the chat box. The next question is, how is COVID taken into account? Would you use an additional year for the valuation?
Yes. COVID is really a mixed message, if you can believe that. Some businesses have thrived under COVID. And of course, some businesses have not. So right now might not be the best time for those businesses that have had a difficult time for COVID in terms of the value, but it's still okay to run the value and see where you stand and what you can do to improve. But that's why you need to have that maybe 3 years out strategy to see, how things are going and how you can improve the value.
The next question is, my business has a GSA Stars 3 contract, a DHS IDIQ contract, JETS. Can these potential income of being on these exclusive contracts be added to the value of the business?
That's probably more a negotiable thing, when this valuation is, I would like to say it's your starting point. But if you have other assets that that could possibly add to the value of the business, that is something that you and that potential buyer would have to take a look at. Remember, people are buying historical value, not potential value. The seller wants to increase his value, saying, hey, there's a potential for increase, but the buyer, I'm buying what you have done. So, certain things are going to have to be negotiable. You have any thoughts, Jose?
Yeah, I mean, there might be some particularities to that business that are different from the benchmark that the software is using. So for that particular case, it's really important to have some meetings with the client, with the SBDC, where we can additionally, run valuation using the discounted cash flow, for example, That's an additional methodology that can include the value of those particular contracts in the future, and come up with a modified valuation. So yeah, I mean, the software, as Pauline mentioned, is a starting point, but the added value of the consultant, it's important to understand the particularities of the business and do the proper modifications.
Thank you both. So this is the last question we have right now that I can see. If you guys are still typing, we will continue to take questions. Oh, we got another couple coming in. After the applicable documents are provided, what is the expected turnaround for an evaluation? Thank you.
Probably between a week or 2 weeks, depending on, you know, how busy we are in the office. So I would probably say between a week and 2 weeks.
Does the software include intangible assets such as patents?
Yes, yes. We can put some intangible assets in there, but, and that would not be a problem. But always remember, a business is valued as much as somebody is willing to pay for it. And, you know, so that would be on paper. If you think this is what the patent is valued at, yes, definitely, we could put that in there. But, you know, that's also negotiable points. And that's where, as Jose mentioned before, the consultant can help you to figure out how to do a different type of presentation.
Just a comment, excellent presentation, thank you. So far, I think that's all the questions we have. If we get any more in, I will definitely let you guys know.
All right, so thank you so much for joining us in this seminar. We are here to help you. Please reach out to any of our business consultants. Go to our webpage and then you can click request consultation with us, and you can specify if you need a valuation report, and we will be happy to provide one. Also, we have other services, as Teresa mentions. Don't hesitate to reach out to us, and we are your best partners to improve and make sure that your business is successful. Thank you so much.
We did get one more question. How do I get started with the valuation? Who do I contact? Thank you so much for that question. I think it was coming into me as Jose was just mentioning. The best way to get this evaluation is to get in contact with one of our consultants. You would go to sbdcorlando.com/consulting and register for consulting. And then one of our consultants will be able to call you back, and you can have that first meeting to have a discussion about your valuation, and then that's how you get started. Pauline, is there anything else you would like to add before we wrap up the webinar?
Just to say, it's a very easy process for the business owner. So for the all you need is that 3 years financial statement, income tax returns, and balance sheet, or income statement or balance sheet, or the income tax return. So once you give us that, we'll be having the conversation with you as to what's the purpose of the valuation, and you know, we can move forward with helping you. And as said, noted before, we have many other services, so we can help you to improve the quality of your business and help you to get where you want to take your business. That's it for me.
All right, great. Thank you guys so much. Okay, I thought I was going to be able to switch controls, but it looks like it's not working for me right now. Our ending slides, as you guys will see in the handout, is just some information about how to get a hold of us. And again, you all will be receiving your evaluations. We do request that you please fill out those evaluations. They are very important to us. They do help in determining the kinds of classes we produce in the future. If one is more liked than the other, it is more likely to get updated and represented. So please take that moment. In about an hour, you should receive an email with the evaluation link. And we hope to see you again at another event or in one of our consulting meetings. Thank you, everyone, and we hope you have an excellent rest of your day.